Mozambique's coal industry is a great example of Murphy's Law in action. It was been hampered by a perfect storm of weaker coking qualities, lower coal prices, and infrastructure bottlenecks. In 2008, during the height of the boom, massive high-quality deposits in the country were invested in heavily. However, upon further sampling, they found that the qualities of the coal were poorer than expected and had higher phosphorus levels, which leads to a more brittle iron. Rio Tinto invested $4 billion in Riversdale mining and did so with the assumption that they were going to be able to dredge and barge along the Zambezi River. For a multitude of reasons, that never eventuated, resulting in bottlenecks that the country struggled to overcome. Vale has spent over $4 billion so far on its own rail and port facilities to overcome this. However, the project has been delayed several times from flooding and even a collapse of the coal stacker at the deepwater port at Nacala. Only now is it starting to overcome this, and we expect tonnage to ramp up significantly. This has all coincided with falling coal prices, the outcome of which in 2015 not a single tonne of export coal from Mozambique was profitable. There are 3 active projects in Mozambique at the moment, 2 future projects and 1 idle mine. ICVL bought Rio Tinto Mozambique and is unlikely to be able to ramp up production from its Benga mine beyond 1 million tonnes a year before 2018. It will hopefully eventually reach around 6 million tonnes a year. As a result, its larger 16 million tonne per year Zambezi project isn't likely to start production before 2022. Vale's Moatize mine is expected to be producing at 22 million tonnes a year within the next year or so. Its rail and port facilities have just been completed, but we expect the ramp up to be more gradual, with production reaching that target in 2019. The Talbot Group's 8 million tonne per annum Revabui project is unlikely to go ahead at current prices. However, with infrastructure maturing in the country and a low capex cost of the project, it is viable from 2020. Jindal's Songa mine is meant to be producing at 10 million tonnes per annum already, but that's unlikely to be met before 2024 as the company instead focuses on cutting its operational costs and waiting for the market to improve. And finally, Beacon Hill Resources' Minas Moatize mine was closed in 2014 due to high costs and low coal prices. The company's since gone bankrupt, and we don't expect the project to ever come back online. The Minas Moatize project aside, AME expects all the other 5 major projects to continue and eventually reach their nameplate capacity. As such, it's possible that in 2025, Mozambican metallurgical coal exports can exceed 40 million tonnes per annum. At that time, we forecast that Mozambique's average cash margin for metallurgical exports could be around $22 a tonne. And while this is far below the profit expectations of these companies when they're investing heavily, it can still result in over $1 billion in annual profits between 2025 and 2030.